So basically, the value of the gift is valued on the day the gift is complete, and it's valued at the fair market value on the completion date. Completion date can be really important. So we just talked about how you can have a $14,000 annual exclusion per person. So if my grandmother gives me a check for $12,000 in December 2013, and I don't cash that check until January of 2014, well, the gift's not complete until January. So whereas Grandma wanted to use that annual exclusion in 2013 and then again in 2014, now I've blown it for her because I didn't cash my check until 2014. And the gift can't be complete until 2014 because it's not immediate funds until I've actually put it into the bank. Up till that point, she can actually stop being considered irrevocable at that point. So that's kind of important. You have to pay attention to that. Fair market value is basically what a willing buyer and a willing seller would exchange for the gift, for the property. And you have to, sometimes you have to do appraisals. It depends on the value of what you're gifting as to how far you have to go in order to please the IRS. Discounts can be applied. For instance, let's say somebody has a limited partnership and they give you a share of that limited partnership. As long as you're not the general partner, the gift of that limited partnership interest is going to be less than the actual value of the interest. Basically what that means is, let's say the limited partnership just has cash and it has $10 million in it. If you were to give me an interest in that, let's say you give me 10% of that, well, my interest should be worth $1 million. But if you give me a limited partnership interest worth 10% and I'm not the general partner, you can argue to the IRS that it's not worth $10 million because I can't go sell it on the open market. The general partner has complete control. So the IRS has been known to discount, 20+%. So that can be very important what kind of gift it is, how it's categorized. Okay, who pays the gift tax? Well, first of all, there is potentially a state gift tax if you live in a state that has them. I live in Florida. We don't have it here. But let's talk about the federal gift tax. So the tax is actually due from the donor, from the person who made the gift. They have to file what's called Form 709. It's an IRS form. And what they do is they declare the full value of the gift. Again, they may have to have had some sort of professional appraisal on the item. And they declare the full value of that gift. Then they can reduce it by deducting that $14,000 annual exclusion if it was an interest gift. And then the net value is what is actually subject to gift tax. Now, what I need to explain to you is that just because it's subject to gift tax doesn't mean you have to pay. Why I say that is because currently there's an exemption for estates and gift tax, and I'll explain in a second. That's $5.34 million per individual, and it goes up every January for inflation. What that means is during my lifetime, I can give away up to $5.34 million gift tax free. Whatever I haven't used, that's still available for my estate when I die. So that's how much I tax without any gift or estate tax. So the donor has to file and tell the IRS isn't going to charge you for the tax, but they're going to take that off the $5.34 million that you have. So they're going to reduce that amount. And I look at it as every person has a line item with the IRS. They all start out at 5.34, and then every time you file a gift tax return and declare a gift, that amount gets reduced. And then at the end of your life, whatever the net number is, that's how much you still have to work with. So for that annual exclusion, again, the $14,000 doesn't even come off that figure. That's why it's so important, if you can use it, to use that. But going back to who's responsible, the donor is responsible to file that return and to maybe pay the tax or at least have it taken off their $5.34 million. If the donor fails to do it, the donee has to do it. The donee can only be responsible for a gift tax up to the amount of the value of the gift. So you can't be made to pay more than you received. But keep in mind, if the tax was due and somebody failed to pay it, then there might be penalties and interest, in which case, arguably, you might be responsible as the donee for more than what you did receive. So if you received a gift, it might be tacky, but if it's a substantial gift, you may want to ask the donor, hey, did you file the gift tax return? And that gift tax return, the gift tax, just as I said, it applies to any transfer by gift of any property. So we talked about what's a gift, how you pay the tax, how you calculate the tax. But what I'm about to tell you is very important. There are certain things that are not taxable gifts. There are things that we might not even have realized could be a taxable gift, but here's a way around them. Number one, we already talked about this one. That's the annual exclusion, $14,000 per person per year. I can go out and I can give to 100 people $14,000 each calendar year. If I'm married, my spouse can give also $14,000 per year. We can even use just my money. My spouse consents to splitting the gift, and I can give $28,000 per person per year. So if you've got a lot of money, it's a very good way of getting rid of some of that money so it's not in your estate without ever having to pay any sort of gift tax on it. Here's the big one, tuition and medical expenses. If you pay as the donor tuition or medical expenses on behalf of someone, but you pay them directly to the provider, which means I pay it directly to the college, I pay it directly to the doctor, to the surgical supply store, to the hospital. Those are not considered gifts. They don't fall into the $14,000. They don't fall into the gift arena at all. And pay attention to this. Here's an example. If my father gives me a check for my tuition made payable to me with the expectation that I'm going to go put that in my bank and then go pay the tuition, that's a gift because he didn't pay it directly to the school. That could be a huge, huge problem. So I always tell my clients, the grandparents who want to do things for their grandchildren, just get the bill and pay it directly. And some people might be uncomfortable with that, but better to be uncomfortable than to do it wrong and have a potential audit later on where they come back and they say, hey, wait, you paid all this stuff, those were gifts. So you want to do that. It's a great tool if you use it properly. Transfers between spouses. If you and your spouse are U.S. citizens and the gifts and the transfers qualify, which most do, then any transfers between spouses are considered no gift and no estate tax. It's called the marital deduction. There are certain exceptions to it. For the most part, it falls onto the marital deduction. Gifts to political organizations, when you make a donation to any sort of PAC or to a candidate, those are not gifts. And also by charities. If you make any payments to a charity that qualifies under the IRS Code Section 501c3, those are usually considered non-taxable gifts and file under the charitable deduction. Last thing we have is special gifting techniques. This is mostly where you want to give a gift, but you don't really want the person you're giving it to get it right away, or you're giving money to a minor. So we talked a little bit before about these irrevocable trusts. If I have a trust that I create for the benefit of somebody else, and it's irrevocable, which means I can't take it back, what I can do is I can create this irrevocable trust for my beneficiaries, as many beneficiaries as I want. When I create the trust, I'm going to put in exactly the provisions that I want, which designate how my beneficiaries are going to get the money, when they're going to get the money, and under what circumstances. I can qualify all this stuff. As long as I'm not a beneficiary under there, and I'm not a trustee usually, then it's irrevocable, it's out of my estate, and now all the appreciation is there for the beneficiaries. So that's a great way of making a gift, and you can make gifts periodically. You don't have to make the gift one time. A lot of times people use life insurance this way. They can create a trust to own life insurance. That life insurance is outside of their taxable estate because they don't own it. It's owned by this trust. Every year, they can pay the premium on the life insurance. They pay it to the trustee pays the premium, and the amount of that premium can be used, you can use the $14,000 annual exclusion on that amount if you do it correctly. Again, there's some strict rules. They're simple, but they are strict. You must follow them. And that's a great way of using an irrevocable trust for gifting. And then the UTMA, that's the Uniform Transfers to Minors account or act. Basically what that means is if you have a small amount of money that you want to give to a child, or that a grandparent or aunt and uncle is going to be leaving for a child, this is the absolute simplest way to handle it. You create an account where there's an adult as a custodian. It's under the child's social security number, so the parent is not the owner, so a creditor can't take the money. The kid can't take the money until they're 21. The parent controls it. So the parent can actually use the money for the benefit of the child. Of course, you would hope that when the child becomes 21 and they are entitled to the money, that they're not going to sue you for misappropriation of the funds, but assuming they don't, it's a very easy way of getting money to a child. I've seen cases where a grandparent leaves money in their will or even in a trust to a child, but they don't put in a provision that says that it can go under the Uniform Transfers to Minors Act. And then you foreseeably have to actually create a guardianship, which is major time, money, and hassle for the sake of the child in order to accept that money, because the child can't accept money unless they're over 18. So I love the UTMA for that purpose. I don't really love it for large gifts, but it's very good for small gifts. It's also good, let's say you want to, we talked about the Facebook stock. Let's say you want to buy Facebook stock for a child. Well, the child can't technically own that stock. So you can buy that inside some sort of Uniform Transfers to Minors vehicle, and they can own the stock that way. Last thing I want to talk about is generation skipping transfers. Now this is a very complicated topic, so I'm going to make it as simple as possible. And again, if you've got any big questions on this, feel free to email or call me. Generation skipping transfer basically is a separate tax, must be paid, or at least accounted for, whenever somebody leaves money or gives property or money to a person who is more than one generation below them. That means grandchild gets money from grandpa. That's called a generation skipping transfer. That exemption is $5.34 million. So it's a nice size exemption, but for people with really large estates, that might not even be enough. So you have to be very careful who you give money to. So you want to be cognizant of that when you're doing your planning, because unlike the estate tax, I wrote on here there's no portability. That means you use it or you lose it. If I die and I've only used $1 million of my generation skipping tax exemption, or GST as we call it, my spouse can't use that. So it's lost. So if my spouse has $20 million and they want to leave that to grandchildren, they can't use that my exemption. They can only use their $5.34 million GST exemption. Interestingly enough, the skipation is defined also in years, which means that if I leave money to somebody, even if it's not a relative of mine, and they're more than 37 and a half years younger than me, that's considering a skip transfer. They're a skip generation. And then another way that this manifests is if grandpa leaves grandchild money, but the immediate child had died, that grandchild's parent, then the grandchild moves up a generation, and therefore it's no longer subject to generation skipping transfer because there was nobody in between. So that's also a way to look at it. When you're doing your estate planning, you want to make sure to tell your estate planner, okay, who's alive, who's not, because that can make a very big difference. And finally on this, there are such things as dynasty trusts, which are designed to make money last for many, many, many generations. And there are ways to avoid generation skipping transfer tax if you use these dynasty trusts. I talked only about gifting today, but basically the estate plan includes gifting. And the estate plan consists of your will, your trust, your healthcare surrogate, living will, powers of attorney, declarations of pre-need guardian. All those things make up your estate plan because you're covering, God forbid, something happens to you and you die or you become incapacitated. How's everybody going to get what they're supposed to get? When are they going to get it? Who's going to be in charge of distributing? When you want to review that estate plan, did you get married? Did you get divorced? Did you have a new child? Major change in financial position, for good or for bad. You always want to look at the estate plan and have it reviewed. If you're moving to a new state, the state laws are different. Sometimes most of the time you should redo your plan. Other times, if you have trusts, you may just need to do an amendment to the trust, but always make sure that you have it reviewed when you move. For instance, Florida, great state to die in Florida. Great state to live, great state to die. We don't have an inheritance tax here. We have the homestead law. So if you move from another state where they had the inheritance tax, where they didn't have other great benefits, you want to make sure that you now redo your documents to comply with Florida law. And since laws do change, it's also a good idea to just really have it quickly reviewed once every year or two, just to make sure that there aren't any laws that have changed that are affecting your plan.